Good afternoon from here. Thank you for joining this channel. If you are a returning subscriber, I welcome you to this channel once again. And if you are a new subscriber or a new viewer, thank you for joining us. So today we'll be explaining IAS 36. IAS 36 is impairment of assets. IAS 36 is impairment of an asset. So this is the note that we'll be using to explain the terminologies in IAS 36. Let's just try to read the footnote. IAS 36 prescribes the basis and procedure that should be followed by an entity to ensure that its assets are not held at the amount that is more than their recoverable value. IAS 36 applies to all tangible and intangible assets, that is, non-financial assets, except those covered by other standard. So what are the key definitions you must know? We have impairment. Don't forget IAS 36 is impairment of an asset. And the reason why IAS 36 come into place is that it tries to govern the assets of a company so that we will not recognize the amount that is higher or that is lower than the current amount of that particular asset in our statement of financial position, so that we will not overstate the amount of an asset or we will not understate it. Now let us try to define the terminologies. We have impairment. What's the meaning of impairment? As far as IAS 36 is concerned, this is the amount by which the carrying amount of an asset exceeds the recoverable amount or recoverable value. The value or the amount by which carrying amount of an asset exceeds the recoverable value is referred to as impairment. Don't forget again, the value or the amount by which the carrying amount of an asset exceeds the recoverable amount or recoverable value is referred to as impairment. For example, let us say we have carrying amount of 5,000 and we have recoverable amount of 3,000. The impairment of that particular asset is what is 2,000, because subtracting 5,000 from 3,000, you have 2,000. That 2,000 is impairment. Are you getting it like that? So if you want to illustrate it in what's it called now, we say that impairment. I'm just trying to save myself from further explanation. This is impairment. Impairment will now be what? Will now be carrying amount minus recoverable amount. That is equal to what? That is equal to impairment. So that is how we calculate for impairment. Do we get it? So definition, we have carrying amounts. The carrying amount we have been dealing with, this is the value or amount that asset and liability are recognized in the statement of financial position. The value or amount that assets and liabilities are recognized in the statement of financial position is referred to as carrying amount. For example, if it's an asset, non-current asset of PPE, then we'll have subtracted our depreciation, accumulated depreciation before we arrive at our carrying amount. And if it is other items, we'll have subtracted one thing or the other. So the value at which an asset or a liability is represented in financial statements is referred to as carrying amount. And then we have recoverable amount. It is defined as the higher of fair value less cost to sales and its value in use. So now don't forget our impairment is equal to what? Is equal to carrying amount minus what? Minus recoverable amount. Now see this carrying amount. Carrying amount, we can get that one. Just subtract your depreciation or account depreciation from your cost. Then you get to carrying amount. But recoverable amount that I refer to as RA, which is equal to recoverable amount is, it can either be fair value less cost to sales. It is higher or fair value. That's what they put there. They said it is the even as it is defined as the higher or fair value less cost to sales and its value in use. The higher is what we are going to bring. The recoverable amount now is now the recoverable amount. It is now the higher of fair value less cost to sales. Less cost to sales. Higher of fair value less cost to sales, or the value in use, or and higher of fair value or less cost to sales and value in use. So they will give you the two. They will give you the two. They will give you fair value less cost to sales, and they will also give you value in use. You will now compare whichever one that is higher is your what? Is your recoverable amount. I believe you get that one as well. So let us continue. We have value in use now. Value in use of an asset. What is value in use of an asset? This is the present value of estimated future cash flow expected to be derived from the use of an asset or a cash generating unit. Value in use is the present value of estimated future cash flow expected to be derived from the use of an asset or a cash generating unit. That is value. That means they will give you the present value of that particular asset. If they will give you the numbers of years in which you are going to generate that income. No, they will give you the cash flow inflow of that particular asset, and you will be given the discount factor. Then you just calculate the present value. So once you calculate the present value, that present value is the value in use. Present value of a future cash flow is referred to as value in use. Then we have fair value less cost to sales. Fair value less cost to sales. This is the estimated amount that will be realized from the sales of an asset less its disposal cost or selling. They will give you the estimated amount that will be realized if they sell a particular asset, and you will now deduct the what? You will deduct the selling expenses from it. Maybe they have advertisements before they sell that particular asset, they advertise or they repair the asset and the likes. Those are the selling expenses. You will deduct it from the what? From the expected amount of that asset. That gives us our fair value less cost to sales. Then we have cash generating unit, CGU. This is the smallest identifiable group of assets for which independent cash flow can be identified and measured. We have corporate assets. These are group of divisional assets of an entity such as head office building, computer equipment, or a research center, etc. So we move to recognition of impairment. Recognition of impairment. Don't forget the other time I said that excuse me, when you are dealing with standard, you check the definition, you check the recognition, you check the presentation, you check the disclosure. Those are the core areas to actually look into while studying IES or any standard at all. Any standard at all. So now we have recognition of impairment. How do we recognize impairment? The basic rules is that assets should not be carried at an amount higher than its recoverable value. Assets should not be carried at the amount that is higher than its recoverable value. Impairment should therefore be deducted from the carrying amount of the impaired asset. impairment should be what? Should be deducted from the carrying amount of the impaired asset. The amount of the impairment should be written off against profit immediately. So that means if impairment is 2,000 naira and the carrying amount is actually 5,000 naira, we use that impairment to reduce the carrying amount. Are you getting me? To let's say the impairment is 2,000 naira, carrying amount is 5,000 naira, then the carrying amount you are now going to represent, that will be represented in financial statement, will now be 3,000 naira, and that 2,000 naira impairment will be used to will be used to reduce the profit in your statement of income, your income statement rather. Do you get? So we have identifying a potential impaired asset. Identifying a potential impaired asset. Statistics suggest how indication of a possible impairment of assets might be recognized. The suggestions are based largely on common sense. So we have external factor, we have internal factor. You can read that one because of our time. I don't want this voice note to be long like that. You can read those ones. So, okay, just let us move to a question. Let us try to solve a question here. Let's try to solve a question here. So we have practical approach. We have PQL. Omo Boy, Nigeria Limited. Believe you can see me. You can see the screen rather. Omo Boy, Nigeria Limited holds non-current assets with a carrying amount of 1,120,000 at December 31st, 2020. The recoverable amount of the asset at that date was 920. Required. Calculate the impairment loss on the non-current asset. So now, in this wise, now we were told that the non-current asset carrying amount is what? 1,120,000. Fair value less cost in sales and value in use. We picked one that is higher. So in this our question now, we were told that it's like this. Let's put million sign here. Million sign here. Then our carrying amount is what? Our carrying amount is 1,120,000. And then our recoverable amount, which is what? Which is 920 million. So we now have our impairment. Our impairment now will now be 1,120 minus this. Let's say it's equal to 1,120 minus 920. So this is our impairment now. So how will it be treated? How will it be treated? So this 200 now will go to our will be subtracted from carrying amounts under statement of financial position now. SOFP. This 200 will be subtracted. Do you get like that? Subtracted from our carrying amount. While this in our income statement, this 200 will be subtracted as expenses. Will be regarded as expenses. Do you get like that? So that is the what? That is the treatment income statement. So this one will be subtracted, credit, right? 200 will be used to relieve the cost of the carrying amount, whereby this one inside the cost statement, it will debit assets and debit expenses. Do you know do you understand the reason why I put? Just let's leave like your carrying amount, whereby income statement you are debiting it, you are recognizing it as an expenses to relieve or to reduce your profit. So that is how to solve a question on impairment of an asset. So we'll be meeting again in the next video. Thank you.